You know what's interesting about financial markets? The truth is almost always more fascinating than the fiction. And when it comes to silver, there's a genuine story worth understanding that doesn't require fake memos or manufactured panic. What I'm going to share with you over the next several minutes is how silver markets actually function, why they behave the way they do, and what intelligent investors should genuinely understand about precious metals. No secret documents, no countdowns, just the mechanics of a market that has confused people for generations. Let's start with a simple question. Why does silver exist as an investment at all? Think about it. You can't eat it, you can't burn it for energy. For most of human history, it just sat there looking shiny. The reason silver became valuable and remains valuable today is because of a quirk in human psychology combined with genuine industrial utility. We're going to explore both of those dimensions, and by the end of this, you'll understand silver better than most people who've been trading it for years. First, the psychological dimension. Human beings have an ancient relationship with precious metals that goes back thousands of years. Long before paper currency, before central banks, before the concept of fiat money even existed, people traded silver and gold. Why? Because these metals had three critical properties. They were scarce, which meant you couldn't just create more whenever you wanted. They were durable, which meant they didn't rot or decay like grain or livestock. And they were divisible, which meant you could break them into smaller pieces without destroying their value. Think of it like this. Imagine you're a farmer in ancient Mesopotamia. You've just harvested a massive crop of wheat, but you can't eat it all before it spoils. So you need to convert your surplus into something that holds value over time. You can't save your wheat for 5 years. It'll rot, but you can trade your wheat for silver, and that silver will still be silver 5 years from now, 50 years from now, 500 years from now. This created what economists call a store of value. Silver became a way to move purchasing power through time. That ancient instinct is still alive in modern investors. When people feel uncertain about paper currencies, when they worry about inflation, when they see governments printing money, their brains revert to that ancient pattern. They think, maybe I should own something real, something that can't be printed into existence. This is why precious metals tend to rise during periods of monetary instability. It's not magic, it's psychology meeting scarcity. But here's where it gets more interesting. Silver isn't just a psychological asset anymore. Unlike gold, which is primarily used for jewelry and investment, silver has become absolutely critical to modern industrial civilization. And this is the part that most investors completely miss. Right now, as you're listening to this, silver is inside the device you're using. It's in the circuits, in the connections, in the components that make modern electronics possible. Why? Because silver is the most electrically conductive element on Earth. Not copper, not gold, silver. If you want electricity to flow with minimal resistance, you use silver. This means that every smartphone, every computer, every electric vehicle, every solar panel, they all contain silver. As the world transitions toward renewable energy and electric transportation, the industrial demand for silver is growing exponentially. Let me paint you a picture of what this means in practical terms. A single electric vehicle contains roughly twice as much silver as a traditional gasoline car. A typical solar panel installation for a home requires about 200 ounces of silver. As countries race to meet climate goals, they're building solar farms, wind installations, and electric vehicle manufacturing plants at unprecedented scale. All of this requires silver, and unlike the psychological demand, which can evaporate when fear subsides, industrial demand is structural. Once you build a solar panel, that silver is locked inside it for 20 to 30 years. It's not coming back onto the market. This creates what's called a structural deficit, where annual industrial consumption exceeds annual mining production. The gap has to be filled by above-ground stockpiles, and those stockpiles are finite. Now, you might be wondering, if industrial demand is so strong, why isn't the price of silver going through the roof? This is where we need to talk about the architecture of modern silver markets. And this is where things get genuinely complex. The price you see quoted for silver, the spot price that flashes across financial websites, is not determined by people buying and going to vaults to pick up physical metal. It's determined by something called the futures market. Understanding the difference between physical silver and paper silver is absolutely essential, and it's where most people get confused. Here's how it works. Imagine you're a solar panel manufacturer. You know you're going to need 10,000 ounces of silver 6 months from now, but you're worried the price might go up between now and then. So you go to a futures exchange and you buy a contract that locks in today's price for delivery 6 months in the future. This is called hedging. You're using the futures market to protect yourself from price risk. On the other side of that trade is someone who thinks the price might go down. Maybe it is a mining company that wants to lock in a selling price for the silver they're going to produce. Or maybe it's a speculator who's just betting on price movements. The futures market exists to facilitate this exchange of risk. But here's the critical detail. Most futures contracts never result in physical delivery. The solar panel manufacturer might decide to buy their silver from a different supplier when the time comes, so they just close out their futures position and take the profit or loss in cash. The speculator was never interested in physical metal at all. They just wanted to bet on the price direction. This means that the futures market has become, in essence, a casino where people bet on silver prices without ever touching actual silver. And the volume of paper silver trading is vastly larger than the amount of physical silver that actually exists. Some estimates suggest that for every ounce of physical silver, there are hundreds of ounces of paper claims trading in the derivatives market. Now, this wouldn't necessarily be a problem if the paper market and the physical market stayed connected. But sometimes they begin to diverge. Think of it like this. Imagine there's a concert and tickets are being resold on a secondary market. The face value of the ticket is $50, but if the concert is really popular, scalpers might sell those same tickets for $300. The paper price and the real-world price have separated because demand exceeds supply. The same thing can happen with silver. The futures market might say silver is $30 an ounce, but if you actually try to buy a physical coin or bar, you might have to pay $45. That extra $15 is called the premium, and it tells you that physical supply is tight. This brings us to a genuinely important concept that serious precious metals investors need to understand: the difference between allocated and unallocated silver. When you buy unallocated silver, you're essentially buying a claim on a pool of silver held by a bank or dealer. You don't own specific bars or coins. You own a percentage of a larger pile. The advantage is convenience and lower storage costs. The disadvantage is counterparty risk. If the institution holding your silver goes bankrupt or can't deliver when you want your metal, you're out of luck. You're an unsecured creditor, standing in line with everyone else. Allocated silver, on the other hand, means you own specific bars or coins that are segregated and identified as yours. If the institution fails, your silver is legally yours, not part of the bankruptcy estate. And then there's physical possession, where you actually hold the metal yourself. Each approach has different costs, different risks, and different liquidity profiles. The reason I'm explaining all of this is because understanding market structure is what separates informed investors from people who get swept up in hype. When you understand how futures work, how premium signal supply tightness, how allocated versus unallocated matters, you can make rational decisions based on your actual goals and risk tolerance. You don't need conspiracy theories, you need comprehension. Let's talk about a real historical example that illustrates how silver markets can break under stress. In 1980, two brothers named Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market. They accumulated an absolutely massive position, both in physical silver and in futures contracts, controlling roughly half of the world's deliverable silver supply. Their thesis was simple. They believed inflation was going to destroy the value of paper currency, and silver would protect their wealth. As they bought more and more, the price skyrocketed from around $6 an ounce to nearly $50 an ounce in just a few months. Other investors saw the price rising and jumped in, creating a speculative frenzy. But the exchanges, seeing that the Hunt brothers were distorting the market, changed the rules mid-game. They implemented something called liquidation-only trading, which meant you could sell your positions, but you couldn't buy new ones. This demolished the price. Silver crashed back down, and the Hunt brothers were financially destroyed. The lesson here isn't that silver is a bad investment. The lesson is that when markets become too one-sided, when leverage gets too extreme, exchanges and regulators will intervene to prevent systemic collapse. They did it in 1980. They did it again in 2022 with nickel when a massive short squeeze sent prices to absurd levels, and the London Metal Exchange actually canceled trades to save certain participants. The rules of the game can change when the game threatens to break the casino. This is why understanding risk management is more important than chasing returns. So what does intelligent silver investing actually look like? It starts with understanding your own objectives. Are you buying silver as insurance against currency devaluation? Are you speculating on industrial demand growth? Are you trying to profit from short-term price movements? Each of these goals requires a completely different strategy. If you're buying silver as long-term wealth insurance, you want physical metal in allocated storage or in your personal possession, you're not worried about short-term price fluctuations. You're worried about long-term purchasing power. You accept that you'll pay premiums and storage costs because what you're buying is certainty and control. If you're speculating on price movements, you might use futures or ETFs because they offer leverage and liquidity. But you also accept that you're playing in the paper market, and the risks are different. Here's a framework that might be useful. Think of your silver position, if you have one, as existing on a spectrum from maximum liquidity to maximum security. On one end, you have futures contracts, extremely liquid, highly leveraged, but pure paper exposure with significant counterparty risk. Next, you have ETFs, more accessible than futures, reasonable liquidity, but still paper claims with fund management risk. Then you have allocated storage. You own real metal, but it's held by a third party. Better security than ETFs, but still some counterparty risk. Finally, you have physical possession. Maximum security, no counterparty risk, but low liquidity and storage responsibility falls on you. There's no universally correct answer. It depends on your personal risk tolerance, your time horizon, and your specific concerns about the financial system. Let me give you a metaphor that might clarify this. Think of silver investing, like choosing how to store water. You could keep water in a reservoir miles away that you share with a whole city. That's like unallocated silver in an ETF. It's convenient, but if there's a crisis, you're competing with everyone else for access. You could install a large water tank at your house that's filled by the municipal system. That's like allocated storage. It's your water, but you're still dependent on the system to fill it. Or you could dig a well on your property and have complete control over your water supply. That's like physical possession of silver. It requires more effort and upfront cost, but it's entirely yours. Which approach makes sense depends on where you live, what risks you're concerned about, and what trade-offs you're willing to make. Now let's address something important. You're going to encounter a lot of content online that tries to scare you into buying silver immediately. You'll see videos with dramatic titles about secret bank memos, imminent market collapses, and insider warnings. Almost all of this is noise designed to generate clicks and commissions. The people creating this content are often affiliated with dealers who make money when you buy. That doesn't mean silver is a bad investment. It means you need to be skeptical of manufactured urgency. Real market analysis is boring. It involves reading supply and demand reports, tracking inventory levels, understanding macroeconomic trends, and making probabilistic assessments. It doesn't involve secret documents or countdown timers. Here's how you can educate yourself properly. Start by following the actual data sources. The COMEX publishes daily inventory reports. You can see exactly how much silver is in registered vaults versus eligible vaults. The Silver Institute publishes annual supply and demand reports that break down mining production, industrial consumption, investment demand, and market balances. The U.S. Geological Survey tracks global silver reserves and production trends. These are boring, unglamorous documents, but they contain the real information that serious analysts use. When you see a claim about silver markets, ask yourself, can I verify this against primary data sources? If the answer is no, be extremely skeptical. Let's talk about inventory levels, since this is often a source of confusion and manipulation. The COMEX warehouse system has two categories, registered and eligible. Registered silver is metal that's available for delivery against futures contracts. It's been warranted and is sitting in the vault ready to be claimed by contract holders. Eligible silver is metal that meets exchange standards and is stored in COMEX warehouses, but it's not available for delivery. It belongs to private owners who are just using the COMEX vault for secure storage. They have no obligation to make that metal available for delivery. This distinction is crucial. When someone tells you there's 200 million ounces in COMEX vaults, they're combining registered and eligible. But only the registered portion is actually available to settle contracts. If registered inventory is 30 million ounces and there are contracts representing 80 million ounces, that's a potential squeeze situation. But it's not automatic. Most contracts are closed out before delivery, and eligible metal can be converted to registered if the owners choose to make it available. The question you should ask is not whether inventory is low in absolute terms, but whether it's low relative to expected delivery demand. And that requires analyzing the data month by month, understanding seasonal patterns, and recognizing that markets are dynamic. Inventory can be replenished. Deliveries can be deferred. Prices can adjust to balance supply and demand. Markets have mechanisms to resolve imbalances without catastrophic collapse. Here's something else worth understanding. Central banks around the world hold gold as part of their foreign exchange reserves, but they hold almost no silver. Why? Because silver is too volatile and too tied to industrial cycles to be a reliable reserve asset for governments. This tells you something important about silver's character. It's a hybrid, part monetary metal, part industrial commodity. When the global economy is booming and factories are running at full capacity, industrial demand drives silver up. When investors get nervous about inflation and currency devaluation, investment demand drives silver up. But when both of those forces weaken simultaneously, silver can fall hard. Understanding this dual nature is essential for managing expectations and avoiding disappointment. Let me share a perspective that might seem counterintuitive. The best time to buy silver is usually when nobody is talking about it. When the precious metals community is quiet, when premiums are low, when sentiment is neutral or negative, that's often when you're getting the best value. Conversely, when everyone is screaming about imminent shortages and you're seeing 10 videos a day about silver squeezes, you're probably near a local top. This is the nature of markets. Fear and greed drive prices to extremes in both directions, and the disciplined investor buys when others are fearful and sells, or at least doesn't buy more when others are greedy. I know that sounds like a cliche, but it's a cliche because it's true. What about the geopolitical dimension? This is real and worth considering. Countries like China, Russia, and India have been accumulating gold and, to a lesser extent, silver as part of a long-term strategy to reduce dependence on the US dollar. As global trade patterns shift, as reserve currency dynamics evolve, precious metals could play a larger role in international settlements. This isn't a conspiracy. It's documented in central bank reports and international monetary policy discussions. The question is how quickly this transition happens and how much it affects price. Reasonable analysts can disagree on the timeline and magnitude, but the trend is observable. Similarly, the green energy transition is real. Solar panel installations are growing globally. Electric vehicle production is ramping up. These technologies require silver, and substitution is difficult because of silver's unique properties. This creates genuine structural demand that didn't exist 20 years ago. But it's also worth noting that technology evolves. Companies are constantly researching ways to reduce silver content in solar panels or find alternative materials. The amount of silver per panel has already decreased significantly over the past decade, even as total installations have increased. So while the trend is favorable for silver demand, it's not a one-way street. Here's my attempt at an honest synthesis. Silver is a legitimate asset class with both monetary and industrial characteristics. It has a role to play in a diversified portfolio, particularly for people concerned about currency debasement, inflation, or systemic financial risk. The industrial demand story is real and growing. The supply situation is tight relative to historical norms, though not catastrophically so. Prices could certainly move higher over the coming years as these dynamics play out. But silver is also volatile, subject to speculative manias, and can deliver long periods of disappointing returns. It doesn't pay dividends or interest. It just sits there, hoping its purchasing power increases. Whether that makes sense for you depends entirely on your financial situation, your risk tolerance, and your worldview. If you decide to invest in silver, do it thoughtfully. Determine what percentage of your portfolio it should represent based on your overall asset allocation strategy. Most financial advisors would suggest that precious metals should be a single-digit percentage of your total portfolio, not the majority. Decide whether you want physical possession, allocated storage, or paper exposure based on your specific concerns and convenience preferences. If you buy physical, understand that you'll pay premiums above spot price and you'll have to store it securely. If you buy paper, understand the counterparty risks and the possibility that physical and paper prices could diverge in a crisis. Set clear criteria for when you would add to your position, when you would hold steady, and when you might reduce exposure. Having a plan prevents emotional decision-making when prices start moving dramatically. And please, develop the skill of distinguishing between information and manipulation. Real analysis provides data, context, and acknowledges uncertainty. Manipulation creates artificial urgency, claims exclusive insider knowledge, and pushes you toward immediate action. The financial world is full of people who profit from your fear and your greed. The antidote is education, patience, and critical thinking. One final thought. Markets exist in cycles. There will be times when silver is genuinely undervalued and times when it's overvalued. There will be periods of shortage and periods of surplus. There will be moments of opportunity and moments of danger. Your job as an investor is not to predict every twist and turn. Your job is to understand the fundamental dynamics, position yourself according to your goals and risk tolerance, and avoid being swept up in the emotional extremes that destroy wealth. The people who succeed in markets over the long term are not the ones who catch every move. They're the ones who avoid catastrophic mistakes and stay in the game long enough for their sound principles to compound. Silver is neither a guaranteed path to riches nor a foolproof insurance policy against collapse. It's a metal with interesting properties, complex market dynamics, and a role to play for investors who understand what they're buying and why. If you approach it with clear eyes, reasonable expectations, and a commitment to ongoing education, it can be a valuable component of your financial strategy. If you approach it with fear, greed, or the belief that secret knowledge will make you rich overnight, you're setting yourself up for disappointment. The real opportunity in any market is not in chasing rumors or acting on manufactured panic. The real opportunity is in understanding how things actually work, recognizing when prices diverge from underlying value, and having the discipline to act on that knowledge, even when it's uncomfortable. That's true for silver. That's true for every asset class. The game rewards competence and patience, not reactivity and wishful thinking. So educate yourself, read the boring reports, track the actual data, think critically about what you're being told and who benefits from you believing it. Make decisions based on your genuine financial needs and risk tolerance, not on fear that someone else is getting rich while you're missing out. And remember that wealth is built over decades, not days. The most important thing you can do is simply not lose. Avoid the catastrophic mistakes, ignore the noise, and stay focused on what actually matters. If you can do that, you'll be ahead of 90% of the people playing this game.